Well, this week we're reviewing the RCM Global Fund. Taking a look at the managers, you've got Daniel Malan, Piet, Viljoen and Wilhelm Hertzog. It was formed in March 2006. Fund size $353.7 million. The objective MSCI World Index plus 2.5% and a very low cost TR sitting at 0.58%. Let's throw over to Linda just to give us the philosophy underlying the fund and just a key focus of the fund, Linda.
So it is a global equity fund, so it's equity-centric. It's measured against an equity index, being the MSCI World Index. And it's been going now for, as you previously mentioned, just over 6.5 years now. And effectively, it is managed on the same basis as all of our funds, which is that it's fully flexible between equities and cash. So in the market environment where we can't find enough absolute value opportunities, we're able to defer to cash and hold as much cash as we need to deploy when we find those opportunities again.
So let's just see that asset allocation graph there, because you can see the exposure to equities really.
Yeah, I mean, I think that's important. Just have a look at the asset allocation quickly. And this is now obviously up to the end of July. And you look at the total, you just look at the total equity block there at 77.3%. And that's what Linda was talking about, is the fact that they like to hold cash during certain market cycles, because obviously it allows them the dry powder in order to actually spend back into the cycle should they wish to do so. Just to quickly give you an indication of what the total returns of this fund actually look like over time, and this is now on a rolling basis. You can actually see the fund's return relative to benchmark. You see some underperformance relative to benchmark, but overall there's a fairly decent profile of outperformance over time. Yep. Some underperformance obviously during 2010 and 2011, and you can see the benchmark obviously here, which is the MSCI plus 2.5, and you can see how that has actually performed over time. So overall, I mean, one of the things that kind of stands out here for me is the fact that you're buying an equity fund that actually for me prices like an ETF, and you're actually getting active performances and active fund management relative to that at the end of the day. I mean, for me, it's a fundamentally cheap kind of price to pay. Linda, would you agree with that? I mean, 58 points is really cheap for a global equity fund.
It is. That is a function of how the performance fee is measured. The way that this fund is priced is that there is 0.5% base fee, and then we participate in excess returns once the portfolio outperforms its index by more than 2.5%. Then we participate and we have 20% of that excess return. So what it means is that if we outperform by 5%, for instance, we would then earn another 0.5%, and we would earn 1% in total. Now what happened is that this has a high watermark, and you can see that in the early stages, just prior to the financial crisis, in fact, we were holding around 45% cash. And obviously that was lagging the index quite substantially, and we're actually still making up that underperformance. So at the moment, you know, that translates into a very low TER for the fund.
Take a look at the returns.
Yeah, I think that's important. Let's just have a look again at the table on your screen, and you'll have a look at what the returns actually look like for this fund. Obviously, these are all now basic, again, in dollars. You see the 1 year return there, 1.8 versus minus 1.4, and you can just kind of cast your eye right down there, and you can just have a look at the return. Since inception, 5.2 versus the benchmark of 1.7. So I mean, there's certainly skill involved in order to kind of create those kind of returns.
Linda, when we look at the geographical allocation, it looks like, of course, you have been deploying some of those cash into markets like the United States, heavy weighting there, 50.7%, Japan 17.3%, and the European Union 15.9%. So just talk to us about the specific territories where you invested.
Well, yes, the biggest exposure is really to US listed companies, but that is a little bit misleading in terms of where the revenues are generated. A lot of these companies have globally diversified revenue streams, and a lot of them are actually getting revenues from the emerging markets as well. And good examples of that are Johnson & Johnson, Microsoft, Dell, Coca-Cola Hellenic, which I'll talk about briefly. But the crucial thing about an absolute value-oriented fund is that if you want to buy high-quality companies, and that's what we seek to own, high-quality companies, when they are cheap relative to what they're worth, you have to buy them when they're out of favor, when there's bad news. So if you look at where we have exposure, we have quite a bit of exposure to Europe at the moment, and Japan, both areas which are not very favored by global investors. And in Europe in particular, we have some exposure to Greece. Now that might not sound very wise, but if you actually look at the investment, it's Coca-Cola Hellenic is our primary investment in that that area, listed in Greece. The reason why it's listed in Greece is that it was started by a Cypriot family. This is the largest independent Coca-Cola bottler in the world. It operates in 28 regions, and its primary revenues come from Nigeria, Romania, Poland, a lot of emerging market exposures, in fact. So it isn't actually a European domestic business. Now, because it's listed in Greece, the baby's been thrown out with the bathwater, and it's trading at incredibly cheap levels. So that's what we look for. We look for high quality companies that are out of favor for some reason today, and as a result are trading at substantial discounts to what we believe they're worth.
What do you think of the stocks in the portfolio, the top
Yeah, this is actually a very interesting fund. I did a bit of homework and digging here, and there's a 5% holding about in Berkshire Hathaway, and what is interesting is the other shares in the portfolio are remarkably what is already in the Berkshire Hathaway fund. So I'm seeing Viljoen as a sort of South African Warren Buffett equivalent. For example, Johnson & Johnson, which is a big holding in this fund, is also held by Berkshire Hathaway. Berkshire Hathaway doesn't own BP, but they own ConocoPhillips. They're also a big holder of Coca-Cola. They don't hold any IBM in Berkshire Hathaway. Sorry, they don't own any Dell, but they've got IBM. So it's like a very similar kind of portfolio to what you would see from a Warren Buffett with a Viljoen overlay, I guess.
Well, there we go, the Warren Buffett perhaps of South Africa. That position is being debated. We've got the PSG, Mr. Yanni Mouton, who also competes for that space. But Linda, thank you so much for joining us, of course, from our Cape Town studios.